I have changed my presentation because everyone speaks about Target. I didn't want to talk about Target, but now I do. Now I do, and I've assembled a few transparencies. I will show you how I see the problem. This is my map, you know. This is the same map, which has more arrows. The yellow arrows are money flowing for goods purchases. The green ones are loans, credit. So the north gives credit to the south, and the south buys goods in the north. And when these things balance out across the borders, we call that a balance of payment equilibrium. No? As much money flows into the country as is leaving. That was the situation until 2007. Actually, huge current account deficits had developed up to then because there was this unlimited firing power of the ECB system, which was introduced. One wonders why there was this interest convergence from 95 to 97, and I think it is basically the trust being given by having a common currency with all the firing power of the ECB. There was an unlimited amount of money in the window that induced interest convergence very early on, that induced credit flows to the south, that induced bubbles via the government sector, via the private sector in Spain. These bubbles did create real growth, but they inflated the price levels and deprived the countries of the south of their competitiveness. That is what all this money in the window has created for a long period of time. Actually, that's the problem which will be hard to be resolved because it's not sustainable. The capital markets at some stage decided they would no longer be willing to finance that. There was the sudden stop of credit flows while the southern countries still wanted to finance their Volkswagens and other cars, but all of a sudden there was a was a balance of payment deficit. The money was flowing out to the north, but it was not coming in terms of credit. It's exactly the same story as Stephen said, but in addition there was outright capital flight, so the existing stocks were being returned. The banks of the north required debt redemption. So they were not willing to roll over the short-term debt, and the banks of the south would have to repay their loans without getting new ones. So these things happened all of a sudden. And well, the money flows out, and this money which flows out is measured by the target. Exactly this, nothing else. No? The target balances is an accounting system that tells us exactly the net flow of money to the south. Flow because goods continue to be bought without being financed through capital inflows, plus the capital flight, the outright capital flight. And both is measured by the target imbalances. These target imbalances are credit being given from the north to the south. Why? First of all, it's an accounting interpretation of this credit. The central banks of the north get the payment orders of the south for debt redemption, for goods purchases, and have to give credit to the recipients of this money by putting this on the right-hand side of their balance sheets to carry out these payments on behalf of the southern central banks. So they give them credit. They don't give them money, they give them credit. It's as if I have my car with my friend has a car in the garage and we want to pick it up. I drive him there to take his car back, and he forgot his wallet. So I pay on his behalf. I give him a credit by paying on his behalf. That is what the Bundesbank, for example, has done. That is one immediate interpretation of this credit. But there is another interpretation, namely the fact that there was a net outflow of money requires something else to happen, namely extra money printing, refinancing loans in the southern countries. Otherwise, the stock of money couldn't be flowing out. It would, after a few months, all the money would have left. There would be no money for transactions purposes anymore. So there is also extra money printing and extra refinancing credit. That's the second interpretation why this is a credit. And so the printing presses were activated in the south, allowing this overflow of money. And that is the unusual situation. The printing press normally prints an amount of money which is needed for internal circulation. There is no net flow if we have a balance of payment equilibrium, but there is a certain amount of money, base money, circulating within Spain, in Italy, and so on. But now in this period, extra money printing happened, electronically. I always speak about electronic printing. And this allowed an overflow of money to the north for the purpose of debt redemption, for the purpose of buying goods. That is what is happening. And in the north, well, there is an excess liquidity. The banks in the north have an abundance of liquidity, don't know what to do with it, and hand it over to their central bank. So they lend to the central bank. So basically what we see is a conversion of capital being invested in private assets in the past into capital being invested in the respective domestic central bank in the north. 750 billion of German savings have thus, in this process, been converted from being invested in marketable assets in the south into mere claims against the Bundesbank. 750 billion. So it's a reconversion of savings. So that is basically what is going on. The question is, why is it possible that more money is printed in the south? How come? How can a little country like Greece print as much money as it wishes to finance its needs in foreign transactions? Shouldn't there be a contingency so that a small country has a small printing press and a big country has a big printing press? Shouldn't there be some proportionality between the size between the size of the country and the size of the printing press? But the answer is there is none. Even a small country can print as much money as it wishes, according to the rules of the ECB. The ECB specifies what kind of collateral is needed for refinancing operations, and if you provide them, you can print as much money as you wish and lend it out to your commercial banks. But there is one element, of course, that creates a sort of proportionality, namely the quality of the collateral. If the quality standard is high, then you don't have enough collateral. So Greece simply doesn't have the collateral to print as much money as it wishes, you could think. But now comes the ECB. The please allow me to use that term, the 70% majority which the Club Med has in the ECB Council decided that they reduce the requirements for collateral from A- to BBB-. Then they exempted Greece, Ireland, and Portugal entirely from any rating requirement for the government debt which was provided as collateral. Then there was lots of ELA credit where the ECB didn't care at all about the collateral. Now we have non-traded ABS paper which was given so you could create these sausages out of your private credit claims and use them as collateral, and now even company credit is directly allowed, and so on, and so on, and so on. We move down the ladder over time because more and more collateral is being used for the increasing refinancing stock. By now, the total amount of base money created in the 6 crisis countries is 125% of the total base money existing in the Eurozone. That is, there is no net refinancing credit in the North. To the contrary, the money comes from the South and is being shredded in the North. And that there's no limit to this process. How do the Americans do it? In America, you can't do that. If a district Fed, there are 12 districts, wants to print more money than is needed for its own circulation and makes a payment order to another district Fed, like with my friend, drawing a credit from this other district Fed, it has to redeem this credit once a year in April by handing over something. Originally it was gold. It always was gold. Then it became gold-backed securities, and now it is some other types of securities, but there is a portfolio held by the Fed whose ownership shares are being reallocated between the district Feds. And here you see the difference. These are the American target balances relative to American GDP. It's the gross sum, and you see they do develop to some level, 2%, 2.5% in the crisis, but here in April, something is happening. Here, in anticipation of this date where you would have to pay, they reduce the refinancing credit because they want to avoid, the local district Feds, they want to avoid handing over their assets to other district Feds. So that increases the interest rate, and with an increasing interest rate, more private credit is flowing into these districts. Here, you see the sharp vertical line. Here they actually redeemed in April. Here, 2011, the Fed decided to make an exemption. Nothing had to be done. But a year later, this April, everything had to be brought down to zero. And this is the European curve. The sum of target balances in Europe relative to European GDP, it explodes. It explodes. We have 980 billion, nearly 1 trillion euros gross target. In the old days, this would have been gold.
Hans, can I bring you back to this side because you're on the micro?
Okay. In the old days, this would have been gold. In the Bretton Woods system, Germany had also a balance of payment surpluses with the other European countries, which were part of the system. And these surpluses were always paid with gold. So Germany at the time accumulated a stock of gold of 3,500 tons, which is exactly the same as the target balance. Now there is a claim against a system which can never be called due, which carries a rate of interest of 0.75%, while the inflation rate is 2%. So what's the market value of a claim with a negative real rate of interest? 0. So that money is lost, meaning that countries like Germany, Finland, the Netherlands have created claims through export surpluses which are lost, even if no explosion takes place. If nothing happens and these sums stay there, they will never ever return. And then one can talk about crisis crash scenarios. I don't want to do that. So we don't want these sums. There are two possibilities. One is going the American way. That is, you make it more difficult to agitate the printing press, interest rate rises, and therefore capital flows in. That reduces the balances. That's the American way. It's a tough approach. You have declining areas which are forced into a real devaluation, but improve their competitiveness. But the European alternative, which we go with the banking union now, is very different. There is already the golden credit card available, and in order to make sure that you don't overuse it, you add the platinum card also. Then people can choose between the platinum card. So what I mean is we install collective insurance systems which provide the necessary safety for the capital flowing from the north to the south to go to places where it wouldn't like to go anymore. So we artificially subsidize the capital flow to the south because, after all, this sort of credit insurance is provided free of charge. That's the European solution. I tell you, this is a solution which will lead directly to disaster. It is a continuation of the mistake we made from the very first moment by having the ECB and having the unlimited firing power, reducing artificially the interest differences, although the repayment probabilities were not the same. And so we continue with this policy. Therefore, we continue building up foreign debt by these countries, reduce the forces that would make the respective countries competitive by realignment. By realignment through having lower inflation or even deflation than their competitors in the Eurozone. According to a study of Goldman Sachs, Portugal would have to cut its prices by 35% to be competitive, Greece by 30%, Spain by 20%, even France by 20%. But these necessary realignments will not take place as long as we organize cheap credit covering the current account deficits resulting from it. Thank you.